Welcome to the deep dive. Today, we're going to go beyond just the headlines of the Indian mutual fund industry.
Yeah.
We've got a whole stack of reports that you've provided,
Yes.
and we're going to dive deep and really uncover what's happening behind all these impressive asset figures.
Absolutely. Yeah, we're talking profitability,
Yeah.
competition, the whole ecosystem. You might be surprised by what we discover about who's really winning.
Okay. All right, let's get into it. Our main source today is going to be the India MF Industry Beyond AUM report. That's from December 2024.
Okay.
Just to set the stage, this industry is huge. 44 fund houses managing something like 68 trillion rupees.
Yeah, that's massive.
Yeah.
And that's a six-fold increase in just the last decade.
Wow.
Yeah, so 19% annual growth rate to be exact. And it's not just any investments driving this.
Mm.
Equity and hybrid schemes are really the stars holding over half of the total assets under management.
So on the surface, everything looks pretty rosy, but this report reveals something pretty fascinating. The industry's total income for the fiscal year 2023-24 reached 25,006 crore rupees. And a significant chunk of that 6,438 crore is coming from something called other income.
Other income. Now, this jumped a whopping 83% last year. That's a huge signal that the industry isn't just relying on traditional fee income anymore.
Right.
They're finding new ways to make money, which could be a really good sign for investors looking for a diversified industry.
Yeah, okay, so they're bringing in the big bucks, but where is it all going? The report breaks down the expenses, and it looks like employee expenses take the biggest bite at 38%.
Yeah, followed by IT and infrastructure at 29%. Interestingly, though, marketing is a relatively small slice of the pie, only 6%. This tells me that they're not spending a ton to attract new investors.
Yeah,
Perhaps they're relying more on the industry's reputation and organic growth.
makes sense. Okay, so after all those costs, the industry pocketed a profit of 11,953 crore rupees in that fiscal year 2023-24.
Okay.
That's a significant jump from the previous year, but here's the catch. This profit isn't evenly distributed.
Exactly. There's a clear divide between the industry giants and then the smaller players.
Yeah, the report calls them the big AMCs. And the small AMCs, we're talking 13 big players controlling a massive 87% of the assets,
Wow.
85% of the fee income, and a whopping 89% of the profit pool.
And on the flip side, we have 18 small AMCs that are barely scraping by, holding just a 1% market share.
Right.
And even experiencing a combined loss. This disparity really highlights the power dynamics at play here.
Why is such a huge difference? Is it just because they're bigger?
Well, it's more nuanced than that. It comes down to something called operating leverage. Think of it this way. Imagine you have a factory producing widgets. You have certain fixed costs, like rent and machinery, regardless of how many widgets you make.
Right.
The more widgets you produce, the lower your cost per widget becomes, leading to higher profits. Big AMCs operate similarly.
So as these big AMCs manage more and more assets, their profit margins expand because their fixed costs, like their IT systems or research teams, are spread across a much larger revenue base.
Exactly. It's like they get a volume discount on success.
I like that. Okay, to make this even more clear, let's look at their operating margins. Okay. Big AMCs had a pretty healthy 22 basis points in fiscal year 2023-24. Medium AMCs squeezed out 8, and the small AMCs were in the negative at 149.
Wow, that's a stark illustration of that leverage advantage.
So size definitely matters in this industry.
Yeah.
But let's talk about the overall value of this massive industry. What's it all worth?
Well, the report uses data from 4 publicly listed Indian AMCs and finds their market capitalization to AUM ratio to be about 8.7%.
Okay.
Now, if we apply a slightly more conservative 7% ratio to the entire industry's average AUM of 68 trillion rupees.
We're looking at a total valuation of roughly 4.7 trillion rupees.
That's a staggering amount of potential value for investors.
And this is where things get really interesting while the big players seem to have the advantage.
Yeah.
Does this mean there's no room for the little guys to succeed?
Right. Are there hidden opportunities within this massive industry?
Yeah, that's a great question. Maybe some savvy investors are already looking for those hidden gems.
Perhaps. But before we dive into that, we need to understand how this industry is regulated. After all, we are talking about trillions of rupees.
Right.
There have to be some guardrails in place.
We can't just assume it's a free-for-all. So tell me more about how this whole system is kept in check.
Well, in India, we have the Securities and Exchange Board of India, better known as SEBI.
Okay.
They are the main regulatory body overseeing the mutual fund industry. They set the rules of the game, ensuring a level playing field and protecting investors.
So SEBI is like the referee making sure everything's fair and square.
Exactly. They regulate everything from the structure of mutual fund schemes to the fees AMCs can charge. And they're also quite proactive, constantly introducing reforms to enhance transparency and investor protection.
That's reassuring to know, but I have to admit some of these financial terms can be a bit confusing.
Yeah.
Like, what exactly are TARs? I hear that term thrown around a lot.
Yeah, TAR stands for total expense ratio. It's simply the total annual cost of running a mutual fund scheme, expressed as a percentage of the scheme's assets. It covers things like the fund manager's fees, administrative expenses, even marketing costs.
So a lower tier means more of my money is actually working for me, right?
That's the general idea. And SEBI has been actively working to regulate tiers, ensuring they're fair and reasonable for investors.
Yeah.
This is one way they're protecting your interests.
Okay, that makes sense. So SEBI is playing a crucial role in keeping the Indian mutual fund industry honest. But let's shift gears for a moment. We've talked a lot about the numbers, but who are the people behind this industry? What motivates them?
That's a great question. The report doesn't delve too deeply into individual players, but it does highlight the diverse workforce driving this growth.
Okay.
We're talking fund managers, analysts, sales, and marketing teams, a whole ecosystem of talent.
So it's not just a bunch of finance guys in suits crunching numbers.
Not at all. While financial expertise is essential, the industry requires a blend of skills, analytical thinking, communication, a deep understanding of the markets, and increasingly, technology is becoming a critical factor.
Yeah, I was just thinking about that technology must be transforming how these funds are managed and how we as investors interact with them.
Absolutely. The report doesn't explicitly discuss this, but it's clear that technology is changing the game. From online platforms making investing more accessible to sophisticated data analytics tools used by fund managers. Technology is shaping the future of this industry.
Yeah, this deep dive is already revealing so much more than just the numbers we're seeing. The financial dynamics, the regulatory landscape, the human element, all intertwined.
And we've only just scratched the surface. There's still so much more to uncover. Next, we'll delve into the key trends shaping the future of this industry. Get ready for some exciting developments that could change the way you think about investing.
Sounds fascinating. Let's dive in.
Welcome back to our deep dive into the Indian mutual fund industry.
You mentioned some exciting developments that could change how we think about investing. What did you have in mind?
Well, one trend that's really shaking things up is the rise of passive investing.
Passive investing? I thought all investing was about like actively picking stocks and trying to beat the market.
Well, yeah, that's the traditional approach, but passive investing takes a different route. It's about tracking a specific market index.
Okay.
Like the Nifty 50, rather than trying to outperform it, think of it as kind of going with the flow of the market.
So instead of relying on a fund manager to pick winners and losers, you're essentially betting on the overall performance of the market.
Precisely. And this approach is gaining traction in India for several reasons. Firstly, passive funds usually have lower fees than actively managed funds.
That makes sense. You're not paying for like a team of analysts to constantly research and adjust the portfolio.
Right. And secondly, passive investing has historically delivered solid returns over the long term. It's surprisingly difficult to consistently beat the market, even for seasoned professionals.
So for someone like me who's not a financial expert, passive investing seems like a pretty attractive option.
It can be a great choice for many investors. Of course, it's crucial to do your research and choose an index that aligns with your individual investment goals and risk tolerance.
Right.
But overall, it seems like passive investing is changing the game in the Indian mutual fund industry.
Yeah, for sure. And alongside this shift, there's a growing focus on ESG investing.
Yes, ESG.
ESG, remind me what that stands for again?
Yeah, ESG stands for environmental, social, and governance factors. It's about investing in companies that are not only financially sound, but also prioritize sustainability, ethical practices, and strong corporate governance.
So it's not just about profits anymore. Investors are increasingly considering the impact their investments have on the world around them.
Exactly. And this trend is only going to gain momentum in the years to come. More and more investors, especially younger generations, want their money to reflect their values and contribute to a better future.
Are Indian AMCs catching on to this trend? Are they offering options for investors who want to align their portfolios with their values?
They are indeed. We're seeing a surge in ESG-focused mutual fund schemes being launched in India, catering to this growing demand for responsible investments. This is a positive sign for both investors and the industry as a whole.
Yeah, it's a win-win situation. Investors get to support companies that are making a positive impact, and the industry gets to tap into a new market segment that's driven by purpose as much as profit.
Precisely. And finally, we can't talk about the future of the industry without mentioning the elephant in the room, technology.
You mentioned this earlier, and I'm eager to hear more about how technology is reshaping the Indian mutual fund landscape.
Well, technology is transforming practically every facet of the industry, from how we invest to how funds are managed and operated.
Give me some concrete examples of how this is playing out.
For starters, online platforms and mobile apps are making investing more accessible and user-friendly than ever before. You no longer need to go through a broker or agent to invest in mutual funds. You can do it all from the comfort of your own home with just a few clicks.
That's incredibly convenient. It removes a lot of the barriers that might have prevented people from investing in the past.
Exactly. And behind the scenes, AMCs are leveraging cutting-edge technology like data analytics and artificial intelligence to enhance their investment strategies and manage risk more effectively.
So technology is making the industry more efficient, transparent, and accessible to a wider range of investors. It's democratizing access to financial markets.
That's a great way to put it. And this is just the beginning. We can anticipate even more innovative solutions emerging in the years to come, further blurring the lines between technology and finance.
It's exciting to think about the possibilities, but with all this talk about technology, I can't help but wonder about the human element. Are fund managers going to be replaced by robots anytime soon?
That's a question a lot of people are asking. While technology is undoubtedly playing an increasingly important role, I believe human expertise will always be essential in this industry.
Why is that?
Well, investing isn't just about crunching numbers and analyzing data. It's also about understanding human behavior, market sentiment, and the subtle nuances that can drive market movements. These are things that, at least for now, machines aren't equipped to handle.
That makes sense. There's a certain intuition and experience that comes with being a seasoned investor, something that can't easily be replicated by an algorithm.
Precisely so. While technology will continue to augment and streamline many aspects of fund management, I believe the human touch will remain crucial for making sound investment decisions and navigating the complexities of the market.
I'm curious about another aspect of the human element. We talked earlier about the divide between big and small AMCs. Is there any room for smaller players to thrive in this increasingly competitive and tech-driven landscape? Or are they destined to be swallowed up by the giants?
That's a great question, and it's one that many industry analysts are pondering. While the big players definitely have the advantage in terms of resources and scale, I believe there's still space for smaller niche AMCs to carve out a successful niche for themselves. While smaller AMCs can differentiate themselves by focusing on specific sectors or investment strategies that might not be on the radar of the larger players. They can be more agile and responsive to emerging trends, catering to specific investor needs that the big AMCs might overlook.
So it's about finding those pockets of opportunity where they can leverage their specialized expertise and offer something unique to investors.
Think of it like a craft brewery competing against a global beer giant. The craft brewery might not have the same production capacity or marketing budget, but it can win over customers with its unique flavors. Local focus and personal touch, smaller AMCs can adopt a similar strategy, focusing on quality specialization and building strong relationships with their investors.
That's an interesting analogy. So while the industry landscape is undeniably shifting, it's not necessarily a winner-takes-all scenario.
Right. There's room for both large and small players to succeed, but they need to adapt to the changing dynamics of the market, embrace technology, and find ways to differentiate themselves.
This deep dive is really painting a comprehensive picture of the Indian mutual fund industry. We've gone beyond the surface-level numbers to explore the financial dynamics, the regulatory landscape, the human element, and the forces shaping the industry's future.
And we've only just begun to scratch the surface. There's a whole universe of information within these reports, and I encourage you as a listener to continue exploring and deepening your understanding of this fascinating and ever-evolving industry.
I agree. It's clear that the Indian mutual fund industry is at a pivotal point with exciting opportunities and challenges ahead. And for investors, it's more important than ever to stay informed and make well-considered decisions.
Speaking of well-considered decisions, there's one more trend we need to explore that could significantly impact how investors approach mutual funds in the future. It's a development that's causing a lot of buzz in the financial world, and it has the potential to disrupt the industry as we know it.
Okay, now you've really piqued my curiosity. What is this game-changing trend? All right, we're back, and you were about to reveal this trend that's causing all this buzz in the financial world, something that could potentially disrupt the entire mutual fund industry.
Yeah, exactly. We've talked about passive investing. We talked about ESG considerations, technology. But what if I told you there's a movement that combines all these elements into a completely new way of investing?
Hey, now I'm really intrigued. Tell me more.
It's called personalized indexing, and it's essentially the next evolution of passive investing. So imagine taking the low cost and the broad market exposure of index funds,
Okay.
but adding a layer of customization tailored to your specific values, your risk tolerance, and your financial goals.
So it's like having an index fund that's handcrafted just for me.
Exactly. With personalized indexing, you're not just tracking a standard market index.
Okay.
You're creating your own personalized benchmark
Yeah,
based on the specific criteria that matter most to you.
right.
Let's say you're passionate about renewable energy, and you want your investments to reflect that.
Okay.
With personalized indexing, you can build an index that prioritizes companies leading the charge in clean energy solutions.
That's amazing. It's like taking the best of both worlds, the efficiency and low costs of passive investing, combined with the ability to align your portfolio with like your values and your beliefs. It almost sounds too good to be true.
Well, the technology is still evolving,
Yeah.
but it's rapidly gaining traction. Several fintech companies are already offering personalized indexing platforms, and I expect we'll see more and more traditional AMCs jumping on board in the coming years.
This could be a real game changer.
Yeah,
It really empowers investors to take control of their portfolios in a way that wasn't possible before. It's like having your own personal fund manager, but without the high fees.
precisely. And it aligns perfectly with the trends we've been discussing: passive investing, ESG considerations, and the growing role of technology. Personalized indexing brings all these elements together in a really powerful way.
Yeah, I can see why it's causing such a buzz. It's truly disruptive innovation. But with any new technology, there are bound to be challenges and questions.
Absolutely. One of the key challenges is ensuring that these personalized indices are robust and reliable.
Right?
They need to be constructed in a way that accurately reflects the investor's goals and risk tolerance, and they need to be transparent and easy to understand.
Right. It's one thing to say you're investing in like clean energy or social impact companies, but investors need to know exactly which companies are included in their personalized index
Yeah.
and how those companies are selected.
That's crucial. Transparency and trust are paramount in the financial world, and that applies even more so with a new and potentially complex technology like personalized indexing.
So as this trend gains momentum, it will be interesting to see how regulators like SEBI adapt and ensure investor protection.
Definitely, regulators will play a key role in shaping the future of personalized indexing. They'll need to establish clear guidelines and standards to ensure that these platforms operate fairly and transparently.
This has been an incredible deep dive. We started with some basic facts about the Indian mutual fund industry, and we ended up exploring like a potential revolution in the way we invest.
Yeah, we've seen how the industry is grappling with competition, adapting to new technologies, and responding to evolving investor demands.
We've also seen how informed investors like you can leverage knowledge and insights to navigate this dynamic landscape and make savvy decisions.
Remember, the world of finance is constantly evolving, and staying ahead of the curve requires continuous learning and exploration.
So as you continue your journey in the world of mutual funds, remember to keep asking questions, challenge assumptions, and never stop learning. Who knows what exciting developments await us just around the corner?
And maybe one day you'll be sharing your own insights and experiences on the deep dive, helping others navigate the complexities of the financial world.
That's a goal worth striving for. Thanks for joining us on this deep dive, and until next time, happy investing.